If you've ever considered moving from Canada to the United States for better opportunities, or if you're worried that Canada's best and brightest are leaving in record numbers, what you're about to learn in the next few minutes could reshape your entire understanding of this national crisis. A controversial proposal surfaced last weekend at the Liberal Party of Canada's convention in Montreal, suggesting that skilled Canadians who emigrate should face a substantial exit penalty. While the specifics have been mischaracterized in recent discussions, the very fact that such ideas are being debated signals a deeper problem. Canada is losing its competitive edge, and retirees, near retirees, and working professionals alike are feeling the consequences through higher taxes, stagnant wages, and diminishing economic opportunities. The Canada Revenue Agency is already implementing stricter tracking of cross-border financial movements, and new 2026 tax rules mean that any income, capital gains, or pension withdrawals you take while residing outside Canada will face enhanced scrutiny. If you're a senior receiving CPP, OAS, or GIS, or if you're planning to retire soon, understanding these economic pressures isn't just academic, it's critical to protecting your retirement security. Today, I'm going to break down the real data behind Canada's competitiveness gap, explain what actual policy proposals exist, detail your charter rights that protect your mobility, and give you a concrete action plan to safeguard your financial future, whether you stay in Canada or leave. This is information every Canadian needs, delivered with the clarity and accuracy you deserve. Let's start with the facts. The proposal that sparked this debate did not come from the Liberal Party as an official policy, nor did it involve a specific $500,000 tax figure backed by legislation. What actually occurred was a policy workshop where a private citizen and former technology executive floated the concept of a brain drain mitigation fee during an open discussion forum. These forums are designed for brainstorming, not policymaking. The idea was immediately criticized by constitutional lawyers present at the convention and was never adopted as a formal resolution. However, the viral spread of exaggerated versions of this story reveals something important. Canadians are deeply anxious about the country's ability to retain talent and investment, and that anxiety is based on real economic data that cannot be ignored. Section 6 of the Canadian Charter of Rights and Freedoms explicitly states, "Every citizen of Canada has the right to enter, remain in, and leave Canada." This mobility right is fundamental and cannot be overridden by ordinary legislation. Any proposal that would penalize Canadians for leaving would face immediate constitutional challenge and would almost certainly be struck down by the courts. The Supreme Court of Canada has consistently upheld mobility rights as essential to personal liberty and economic freedom. In the 1991 case of United States versus Catroni, the court reinforced that Canadian citizens cannot be prevented from leaving the country, and any restrictions would require a constitutional amendment, not a simple tax bill. This legal reality is crucial for every Canadian to understand. You have the absolute right to relocate, and that right is constitutionally protected. The historical comparison to currency controls in developing nations is instructive, but requires nuance. Countries like Argentina, Venezuela, and formerly the Bahamas implemented strict capital controls not because they wanted to, but because they faced severe foreign currency shortages, hyperinflation, and balance of payments crises. These measures are acts of economic desperation, not policy preferences. When the Bahamas imposed currency restrictions in the 1980s, it was because their economy was overwhelmingly dependent on tourism and offshore banking, creating extreme vulnerability to capital flight during economic downturns. The restrictions were widely seen as a sign of institutional weakness and actually deterred foreign investment further. Canada is not in this position. We have a stable currency, deep capital markets, and an 8AA credit rating. However, the fact that some Canadians are making these comparisons at all suggests a crisis of confidence that policymakers cannot afford to dismiss. Now let's examine the real economic data that underpins this emigration concern. According to Statistics Canada's most recent data, Canada's GDP per capita in 2024 was approximately $54,000 USD. The United States GDP per capita was about $76,000 USD, a 40% gap. This is not a new trend, but it has accelerated since 2020. The claim that Alabama's per capita income exceeds Canada's by $16,000 is inaccurate. Alabama's GDP per capita is roughly $55,000 USD, essentially on par with Canada, while high-tech states like California exceed $90,000 USD and Massachusetts approaches $95,000 USD. The real story isn't about Alabama, it's about Canada's overall productivity lag. The Bank of Canada has explicitly warned that Canada's lagging productivity means Canadians are getting poorer compared to Americans, and this has direct implications for retirement savings, pension sustainability, and the tax base that supports OAS and GIS. The tax differential is equally stark but more complex than commonly portrayed. A senior with $60,000 in retirement income in Ontario faces a combined federal-provincial marginal tax rate of about 29.65%. In Florida, a popular destination for Canadian retirees, there is no state income tax, and federal rates are lower. A comparable U.S. senior would pay approximately 22% federal tax. More importantly, the U.S. allows larger standard deductions and more favorable treatment of investment income. For capital gains, U.S. long-term rates top out at 20% plus a 3.8% Medicare surtax, while Canada's new 2026 rules mean gains above $250,000 are taxed at effectively 33.3% at the federal level alone, plus provincial taxes that can push the total rate above 45% in some provinces. This is not a trivial difference. It fundamentally changes the math on when and how you can afford to retire. The drivers of Canadian emigration extend beyond tax rates. The Fraser Institute's 2024 report on economic freedom ranks Canada 14th globally, down from 6th in 2010. The United States ranks 7th. The decline is attributed to increased regulation, government spending, and trade barriers. Specifically, Canada's regulatory approval process for major projects now averages 28 months, compared to 8 months in the U.S. This has led to an estimated $100 billion in deferred or canceled investment since 2018, not the $500 billion figure that has been circulated without attribution. When investment doesn't flow into productive capacity, job creation stagnates, wage growth slows, and government revenues suffer, creating pressure to maintain high tax rates that further drive emigration. This is a vicious cycle that particularly impacts younger, skilled workers, whose CPP and OAS contributions are needed to support the retiring baby boom generation. For seniors and near retirees, this competitiveness crisis has direct, tangible consequences. If you're relying on CPP, you should know that the plan's sustainability depends on a growing workforce contributing premiums. When skilled workers emigrate, the contribution base shrinks relative to the number of beneficiaries. The CPP Investment Board has been forced to take on more investment risk to maintain projected returns, and while the plan is actuarially sound until 2090, that assessment assumes immigration will offset emigration. If emigration accelerates among high-income contributors, the math changes. Your CPP retirement pension, which maxes out at $1,364.60 per month in 2026 for those who contributed at the maximum level for 40 years, could face pressure for reduced indexing or increased contribution rates on those who remain. For OAS and GIS recipients, the implications are even more immediate. OAS is funded from general tax revenues, not contributions. If Canada's tax base erodes because high-earning professionals move to the U.S., funding OAS becomes more difficult. The OAS clawback threshold for 2026 is $90,997. If a large capital gain from selling your home to fund U.S. relocation pushes you above this threshold, you could lose some or all of your OAS for that year. More critically, GIS is income tested and based on your previous year's tax return. If you move to the U.S. and become a non-resident, you lose GIS eligibility entirely. For a single senior receiving maximum GIS of $1,065.47 per month in 2026, that's $12,185 annually in lost income, money that cannot be replaced by U.S. Social Security benefits because you haven't contributed to that system. The residential property flipping rule, introduced in 2023 and now fully enforced in 2026, adds another layer of complexity for those considering selling their Canadian home before moving. If you sell a property within 12 months of acquiring it, the gain is treated as business income, 100% taxable, rather than a capital gain, 50% or 66.67% taxable. For estate situations where you've inherited a parent's home and plan to sell it before relocating, this rule can create a massive tax hit. While there are exemptions for estates, they require precise documentation and timely filing. The CRA has clarified that executors must file an election with the deceased's final return to claim the estate exemption, and failure to do so results in automatic business income treatment. This is exactly the kind of trap that catches well-meaning families off guard and can cost $40,000 or more in unexpected taxes. Now let's address the policy landscape. While the exit tax proposal has no legislative path, Canada does have existing departure tax rules that are often misunderstood. When you cease to be a Canadian resident, the CRA deems you to have sold most of your assets at fair market value. This is the departure tax. Your home, if it's been your principal residence, is generally exempt. But your RRSPs, TFSAs, non-registered investments, and business assets are all subject to deemed disposition. You can elect to defer this tax by posting security, but you must file the election correctly. Many Canadians who move to the U.S. fail to file Form T-1243, deemed disposition of property, and Form T-1244, election to defer payment, resulting in penalties and interest that compound while they're trying to establish new lives abroad. The CRA's 2026 guidance clarifies that the $16,500 lifetime capital gains exemption on personal use property does not apply to departure tax calculations, a change that affects many retirees looking to relocate. So what should Canada actually do to retain talent and investment? The solution is not restricting mobility. That would be unconstitutional and economically counterproductive. Instead, Canada needs comprehensive competitiveness reform. First, the government must commit to a 10-year plan to reduce the federal debt-to-GDP ratio from its current 42% to pre-pandemic levels of 30%. This would allow for gradual tax rate reductions without cutting services. Second, Canada should implement a one-window regulatory approval process for major projects, modeled on British Columbia's recent Environmental Assessment Act reforms, but with shorter timelines mirroring U.S. efficiency. Third, the government should eliminate the $250,000 capital gains threshold and return to a flat 50% inclusion rate for individuals, while raising the corporate inclusion rate to 75% to encourage personal investment over corporate hoarding. Fourth, Canada needs to negotiate a modernized tax treaty with the U.S. that allows Canadians who work in the U.S. for part of their careers to count those years towards CPP eligibility, similar to how the U.S.-Canada Totalization Agreement works for Social Security. For individual Canadians, whether you're planning to stay or considering a move, here's your specific action plan. Step 1. Assess your personal competitiveness gap. Calculate your actual after-tax income in your current province versus what you'd earn in your target U.S. state. Use online tax calculators that factor in federal, provincial, state, and local taxes. Include property taxes, which are often higher in U.S. states with no income tax. For seniors, factor in the loss of GIS, 12I-785 year, and potential OAS clawback if you have a large estate. This honest math will tell you whether moving is financially viable or if you're reacting to frustration rather than facts. Step 2. Audit your property titles for bare trust arrangements. If you've added an adult child to your property for estate planning, you may have created a bare trust. Bill C-15's 2026 rules require T3 trust returns for many such arrangements, due March 31, 2027. Consult a tax lawyer before year-end 2026 to determine if you qualify for exemptions. The penalty for non-filing is $2,500 plus potential gross negligence penalties of 50% of unpaid taxes. If you're planning to sell the property before moving, factor in the cost of professional advice. It's far cheaper than the tax consequences of getting it wrong. Step 3. Understand departure tax obligations. If you cease Canadian residency, you must file Form T-1243 and T-1244, with your final tax return. The deemed disposition applies to all assets, except your principal residence and certain registered accounts. For your RRSP, you can elect to keep it as a Canadian account and pay 25% withholding tax on withdrawals, or collapse it and pay departure tax at your marginal rate. For TFSAs, the U.S. doesn't recognize them, so gains become taxable immediately upon becoming a U.S. resident. Plan these moves over 2 tax years to avoid pushing yourself into the 66.67% capital gains inclusion rate. Step 4. Protect your CPP and OAS entitlements. Before leaving, ensure you've contributed to CPP for at least 40 years to maximize your retirement pension. If you have fewer than 20 years of residency in Canada after age 18, your OAS will be prorated. For example, 15 years of residency means only 15/40ths of the maximum OAS, about $279 per month instead of $743. You cannot buy back OAS residency years. If you're close to the 20-year threshold, consider delaying your move. Also, confirm that your new country has a Social Security agreement with Canada, the U.S. does, which allows you to combine contribution periods for some benefits. Step 5. File your 2025 tax return before making any move. The 2026 Bear Trust rules and the new capital gains inclusion rates make 2025 returns more scrutinized than ever. If you sold property in 2025, ensure Form T2091 is completed perfectly. If you're in a Bear Trust, file the protective T3 return even if you think you're exempt. It's a $2,500 insurance policy against a $50,000 penalty. File on time to protect GIS if you're receiving it. Once you file as a non-resident, you cannot receive GIS, so timing matters enormously. Step 6. Seek professional advice early. Consult a cross-border tax specialist at least 1 year before your planned move. The initial consultation may cost $500, $1,000, but proper structuring can save you $50,000 or more in taxes and penalties. Ask specifically about 1. Departure tax elections, 2. RRSP TFSA treatment, 3. Estate planning across borders, 4. U.S. estate tax exposure on worldwide assets over $13.99 million USD, and 5. Canadian exit tax on deferred compensation. Document everything in writing. Verbal advice is not sufficient CRA defense. The broader economic context matters because it affects policy that impacts your retirement. Canada's productivity growth has averaged 0.8% annually since 2020, compared to 1.8% in the United States. This means the wealth gap will continue widening without structural reform. The Parliamentary Budget Officer projects that without policy changes, federal deficits will persist through 2035, adding $300 billion to the national debt. That debt must be serviced, requiring higher taxes or reduced benefits. For seniors, this means OAS indexing could be slowed, GIS eligibility tightened, and healthcare transfers to provinces reduced, potentially leading to user fees for services currently covered. The immigration debate, when stripped of partisan rhetoric, reveals a legitimate policy failure. Canada is not retaining enough skilled workers because we have created a system where talent is undervalued. Our top marginal tax rates kick in at relatively low income levels. Above $235,675 in 2026, you pay 33% federal tax plus provincial rates that can push total taxation above 50%. In Texas or Florida, there is no state income tax, and the top federal rate of 37% only applies above $609,350 USD. A software engineer earning $150,000 CAD in Toronto takes home about $102,000 after tax. The same engineer earning $120,000 USD in Austin takes home about $95,000 USD, roughly $130,000 CAD. They keep more of their income in absolute terms, and the cost of housing, while rising in Austin, is still 40% lower than Toronto's on a price-to-income basis. This is not about patriotism or obligation, it's about arithmetic. Canadians don't owe their country immobility. They owe themselves the best life they can build. The country's obligation is to create conditions where building that life here is competitive. Right now, for many skilled professionals and retirees seeking warmer climates and lower costs, the math doesn't work in Canada's favor. The solution is not an exit tax. That would be economically illiterate and unconstitutional. The solution is a comprehensive competitiveness agenda that includes tax reform, regulatory streamlining, and targeted investment incentives for sectors where Canada has advantages: clean energy technology, critical minerals processing, artificial intelligence, and precision agriculture. The federal government's recent $15 billion commitment to the Canada Growth Fund is a step in the right direction, but it's too small and too slow. We need immediate action on the 2026 capital gains rules, which are already causing investment decisions to be postponed. For you, the individual Canadian, the key is to make decisions based on verified facts, not viral headlines. The exit tax proposal is not real policy and has no path to becoming law. Your charter rights are secure, but the underlying economic pressures are real, and they will affect your retirement whether you stay or go. Get professional advice, understand your tax obligations, file your returns correctly, and time your decisions to minimize tax exposure. Before you make any major decision, hit the like button and share this video with someone who needs to hear it. Subscribe and turn on notifications for weekly updates on how changing economic policies affect your CPP, OAS, GIS, and overall retirement security. Drop a comment below telling me where you're watching from. I read every comment, and your location helps me tailor future content to regional concerns. The debate about Canada's competitiveness will continue, but your financial security is too important to leave to chance. Take control of your planning, understand your rights, and make informed decisions based on facts, not fear. Thank you for watching, and I'll see you in the next video. Smart Pension Canada.